Hey everybody, this is Charles Dobbins. Welcome to this week's episode of the Multifamily Investing Podcast with me, your host, Charles Dobbins, themultifamilyattorney.com. And I'm here today with Paul Moore. And for those of you that are not watching this video live, you're listening to it, just to kind of give you a visual, I have opted for the salt and pepper look, and Paul has decided to go with the full white. And it works great for him. I'll just tell you that right now. So, all right, let me give you an idea because
it makes me look over 50.
Well, I'm 72, so I've got that going for me.
Really?
So, yeah.
You don't look it.
Thank you. I appreciate that. See, nobody ever tells me I look good for 55, but bam, I look good for 72. So I found the right age. And my mother taught me that because she told everyone for years when it was her birthday, she always said, "Oh, I'm 39 again." And I'm like, "Mom, you look like hell for 39. Why you're 72 and you get compliments like I do?"
Right.
So, Paul Moore graduated with an engineering degree and then an MBA from The Ohio State University. I will not tell him that my wife is from Michigan. By the way, my brother just sent out something on Facebook about what other states think of other states. And so it was Ohio people hate Michigan people, and Michigan people hate Ohio people. And, you know, everybody hates Massachusetts and New England. It was a very, very funny thing, but I knew as soon as I saw that Michigan and Ohio would have been loggerheads. So he entered the management development track at Ford Motor Company, Detroit, very similar to our other friend Vern Schmidt, who was in the Chrysler program.
Okay.
After 5 years, he departed to start a staffing company with a partner. Along the way, Paul was a finalist for Ernst & Young's Michigan Entrepreneur of the Year 2 years straight. They scaled and sold the company to a publicly traded firm 5 years later, and after a brief retirement, Paul began investing in real estate in 2000 to protect and grow his assets. Okay, so he picked a good year to get started. He flipped over 50 homes, 25 high-end waterfront lots, and appeared on HGTV's House Hunters. House Hunters International was my most favorite show. I love that show. Oh man.
Yeah.
I mean, and he rehab managed dozens of rental properties, built a number of homes, developed a subdivision, and started 2 successful online real estate marketing firms. Okay, 3 successful real estate developments, including assisting with the development of a Hyatt hotel and a very successful multifamily project, convinced him of the power of commercial real estate. And he's the author of The Perfect Investment, Creating Enduring Wealth from the Historic Shift. Okay, we're going to talk about this when we dig down deep. Create Enduring Wealth from the Historic Shift to Multifamily Housing. That was back in 2016. Paul also co-hosts, and this one we're definitely going to talk about, a wealth building podcast called How to Lose Money. And is featured in guests on numerous real estate podcasts, contributed to Bigger Pockets and Fox Business. And he's married with 4 children. And when we talk about his partners, I think all in all, out of the 3 people in his organization, the 3 advisors, there are 19 children between the 3 of them. So they obviously don't believe in global warming whatsoever. You know, so there you have it. So,
there you go.
Exactly.
There you go.
First of all, I got to tell you, I mean, you and I are you know, we've been through the ringer. The fact, I love the name of your podcast, How to Lose Money. And, you know, I sometimes probably lose a lot of clients when I tell them that my job as their attorney or their coach in the multifamily space is how to protect them from getting screwed. Mm-hmm. And, you know, and when you just, sometimes you just got to tell it like it is and let people know the you know, the good, the bad, and the ugly, as I always say.
Right.
So,
yep, it's true.
So, yeah, and what we're ultimately going to be talking about, and this is what we're going to land on, is Wellings Capital and your business, Wellings Capital, and how you ended up there. But let's dial it back to the year 2000, when you had made some money in other businesses, and you know, get a taste of success. You know, you've obviously been through a couple of cycles already. And you know, you were in the business. I want your answers, straight answers on this, but you were in this business back during the 2007, 2008 period,
right,
where we all got spanked. So talk to me about 2000. When you decided to get into this business, what was your first foray? What were you looking to do? Just give it to me. Give it to me straight, Paul.
Yeah. So when I sold my company, I was only 33 years old. I had a couple $1 million in the bank, and I thought, I'm an investor now. Well, the truth was, Charles, I was actually a speculator, not an investor.
Yeah.
I didn't know the difference between investing and speculating. Investing, I think of it now as, when your principal is generally safe and you've got a chance to make a profit. But speculating is when your principal is not at all safe and you've got a chance to make a profit. And so I was speculating and I made some money, lost some money, but I got pretty bored pretty quickly. And I actually heard that you could buy houses for, 40, 50, 60 cents on the dollar at the courthouse steps. So my buddy and I went down to the courthouse steps with absolutely no money in hand, intentionally just to see what it was like. And we came across a deal that was a really, really good deal, and nobody else showed up to bid. So we quickly ran to the bank and came back, and we bought the house, and we made we put a for sale by owner sign in the yard a few weeks later after just cleaning the house, and we made like $30,000. We got an offer, full price offer within 4 hours. And so we thought, this is easy. We can do one a week. Well, but we lost money on 2 of the next 4 and found out it was harder than we thought. But that's how we got started. We got started through boredom, actually, and then we grew it from there.
Now, let me ask you this, because I don't know if you're familiar with Michael Michalowicz. Do you know who that is?
Yeah, Clockwork. I just read the book.
Profit First.
Yeah, Profit First, and then he wrote a book called Clockwork.
Oh, I haven't read that one yet.
Yeah, it's great.
Okay, I got to write that one down. Clockwork. Okay.
Yeah.
Okay, so let me just tell you something. As you were starting to describe, 33 years old, you sold your business, you got millions in the bank. I was picturing Michael Michalowicz, like his first, sale, and how he ended up blowing all the money. Before he knew it, it was gone. I mean, tell me you were smarter than Mike.
Oh, I'm smarter than Mike. Hey, I had $1.5 million in the bank in December of 1997, and I had $2.5 million in debt 10 years later in December of 2007.
Oh no!
Man.
You did it, man.
Yeah, but here's the good news. I had every bit of that debt was tied up with real estate. And even though, now of course we didn't know we were about to plunge down the black hole of 2008, we assumed that the worst was over in the real estate market. But I'll tell you the quick version of the story, Charles. I actually made a decision. I had a couple friends meet with me and said, what are you going to do? You're going to declare bankruptcy? And about that time, my business partner pulled out and he said, I'm signing all the equity and the debt over to you. I can't make half of these interest payments anymore. We're still friends today, but it was a little rough time. But I made a decision to actually give my way out of debt. And what that looked like is this. I actually really believed in whatever you want to call it, karma or sowing and reaping. And I believed that if our backs were against the wall. So I thought if we start giving aggressively, it's not going to be worse than it is already. We're already backs against the wall. And so we did that. And 4 weeks later, after we started giving the set weekly amount, which was substantial for us, especially being where we were at, we actually came up with a light bulb idea that allowed me to subdivide a large piece of land along on a waterfront and sell the little pieces off, and made a very significant profit. We were completely debt-free 13 months later.
Oh, wow, that's fantastic. And that was all up in Michigan?
That was actually in Virginia. We left Detroit when it was imploding in 1998, and we moved to the Blue Ridge Mountains of Virginia in 98.
Good for you. So like up around the, is that Roanoke or?
Yeah, we moved to Roanoke. In fact, we actually bought 120 acres on top of a mountain outside of Roanoke.
Oh, good for you. One of my best clients lives in Asheville, and he's right on that famous road that goes the
Blue Ridge Parkway.
Yeah, he's on that road, and he's a great guy. So that's so cool. That's so cool that you hightailed it out of Detroit, because I bought in Detroit Michigan in 2006.
Really? Ouch.
Yeah, I know. So, I listened to your story. I got one of my own, and we've been through it all. We can't. That's why when the name of your podcast, don't lose money or lose.
Yeah, how to lose money.
How to lose money. Man, I lost $1 million in the .com boom too.
Did you?
Every cycle I've lost money, and now not so much. Now
Right.
it's not going to happen to me again. That's for darn sure.
Well,
So,
you've been there. I mean, you know the difference between investing and speculating.
Oh yeah. And I tell you, I see these guys out there, and I'm not looking to disparage anybody, but they're, you can try to do the math. But guys who have never been through a cycle, who
I know,
that don't know what it's like to be having to sit down with the bank and talk about how you're going to get out of this personal recourse loan type of situation. It's scary. I teach my students, don't put yourself in that situation. You don't have to.
Right.
There are other ways around it. So it's
Yeah.
interesting. So, all right, well, let's talk about what you're doing now with Wellings Capital, because I'll tell you, I sent my clients, a link to your website. Let me just read to you your paragraph, okay?
Okay.
And then I hate this term, and I've used it twice already today, and we're gonna unpack your paragraph here, okay?
Okay.
Because I think with my legal expertise, this paragraph has so much in it that people don't seem to understand. Let me read it to you. It's Wellings Capital helps high earners, 200,000 plus per year, and high net worth individuals, $1 million, protect and grow their wealth through passive commercial real estate investing. We identify and invest alongside best-in-class operators who have long track records of success and deep experience in their asset class through at least one recession. We have now invested in over 17,000 self-storage, mobile home park, and multifamily units across the U.S. valued at over $500 million. Okay, it's especially that second sentence in there that has so much information if you understand this business and how it works. So am I to believe that what you do essentially is you find the right investments for other investors? And how I came to that conclusion is you said we identify and invest alongside. So are you sponsoring the deals, or are you looking for the right sponsors for people?
We're actually looking for the right sponsors, and I could give you the history of how we got there if you're interested.
Okay. Yeah. Oh, absolutely. This is because I'll tell you something. This is really interesting. I had a podcast interview earlier today where it was a similar situation where someone took a new angle on this business, and I really want to hear what you have to say.
Okay. So we, in 2011, I always had this sense, I don't think I knew that the Forbes 400 wealthiest people in the world almost all invest in commercial real estate, but I did find that out at some point. But I always had the sense, Charles, that I should have been involved in commercial, not just residential. I did more than I even put in my bio there. And I actually stumbled into an opportunity to build a ground-up multifamily quasi-hotel in the North Dakota oil boom called the Bakken oil boom in 2011.
Right.
We owned and operated that for about 3 years to about almost 2014. We sold it when oil was about $100 a barrel. And so that went very, very well. And I decided, and I told my wife of 33 years now, that I was only going to do multifamily from now on. So I dove in head first, got really deeply involved in it, so much so that I ended up writing the book that you referenced earlier. And I plan to do that only. But being in my 50s, I actually was very risk averse, and I decided I didn't want to take any more risks with my money and my investors' money. And so we were very hesitant about the pricing from 2015 on. Cap rates had compressed to a record level, which means, of course, prices had risen to a record level. Yeah. Some of the deals didn't make sense. I've got a list of about 7 reasons that I personally think multifamily is largely overheated. But anyway, we finally, after years of being outbid, and watching our friends who, like, I mean, I have friends like Michael Blanc who, you know, I was saying, Michael, you're paying, you know, I think you're paying too much for that deal. And I don't know if you should buy in Memphis. The net population migration isn't that. Anyway, he would buy it and then he would sell it 2.5 years later for a huge profit or refinance all the equity out. And I'm sitting on the sidelines and I'm finally like, you know, I can't make a living sitting on the sidelines and selling a few books a month. So about 2 years ago, we decided to expand into self-storage and mobile home parks. But Charles, what we found was surprising. 93% of multifamily units, multifamily properties above 50 units are owned and operated by professional operators, people who have already wrung a lot of the value out of these multifamilies. But self-storage and mobile home parks are entirely different. There's a huge percentage of mom and pop operator owners. A lot of them are getting older. They don't know how, or they don't care, or they don't have the resources to actually maximize value. So these can be acquired and upgraded quite significantly. But here's the problem, for us at least. We did not have the experience, the track record, or the team to do this. And we felt like since it was late in the cycle, it would be better for us to go out and vet the very best in class operators we could find. And so that's what we started to do 2 years ago. Last year, a year ago, we put together a fund, and now we invite our friends, family, and other investors to invest alongside us in these very best in class operators. So that's what we do.
Okay. All right. You know, this is where you start talking about this and you just lead me right down another rabbit hole. I got 3 rabbit holes right now.
Okay, let's go.
All right. First up, mobile home parks. I can evaluate a self-storage facility. Fine. It's not that hard to do. I mean, multifamily is my thing. That's all I know. Mobile home parks have always thrown me for a loop. And part of it is that, as I understand it, there are 2 types of mobile home parks, and you only should buy one of them. It has something to do with the sewer and having it be on city sewer, something to that effect. The other thing that has bugged me about mobile home parks is that there are 2 guys who go out there and teach this business, okay, and they're out there selling their weekend course, you know, and coaching, and then come to find out, there's a finite number of mobile home parks that meet that criteria in the whole country, and these guys are out there in the lead trying to buy them up, buy everybody out. So when you graduate from the course, you end up having to compete against these guys. So, all right, so that's your comments, if you have any on that.
I never really thought of that. I actually went to that course at one time, and yeah, they are buying them. I think what's brilliant about what they do is they're partnering with some of their students. So in other words, if I get out of there, let's say I'm 30 years old, I go through the mobile home park classes, I don't have the ability to get a non-recourse loan. I don't have the track record to pull down a deal. I don't have the equity. I don't have all the stuff, but I have this deal I found. Let's say it was Uncle Bob's mobile home park on the edge of Roanoke, Virginia. And I can call them and say, hey, would you partner with me? And so that, I think, is actually a pretty good thing they do for their students.
And that's the same with self-storage. I mean, there's another guy, you know, Scott Myers is the big man on self-storage.
Yeah.
And he does the same thing.
Right. Yes, he does. Scott's got a great mastermind group, and he partners with his people. And Scott's actually part of my new book on self-storage. In fact, he's quoted quite a bit in there.
Okay, so are these the type of owner operators that you guys work with for your funds?
You know, we have about 24 criteria, and one of them, like you mentioned, is we want them to have gone through the last recession. We want to make sure that they have a great team. We want to make sure they're not just a scattered bunch of 1099s, that they're truly a vetted, you know, W-2 team working in a location. And honestly, when we find one that fits all those criteria and many more, it's really tough. Often they don't even need money because they're so good. They've already got that covered. So there's very, very few people that we can work with. But when we do, we have a really good one. We only have 4 operators right now after 2 years of vetting people pretty regularly.
Oh, that is fascinating. First up, the 24-point vetting schedule. I mean, that's really cool. That's that's almost something that you'd want to teach. Is you should write a book on that, Paul,
Mm.
because that's really a good lesson for everyone. The other thing that you mentioned, and this is in that same sentence that I highlighted, has to do with at least one recession. Now, when I read that, my first thought was, well, there are different ways to define a recession, and some recessions you don't even feel them when they come and go. But when you say at least one recession, are you talking about what I talk about, where it's a site, as we call it, a cycle in this business, like 2007, 2008? Is that what you're looking for?
Yeah, we have one operator that's been gone back all the way to 1981 in the self-storage business. But in general, we want them to at least have been doing self-storage or mobile home parks or whatever since before 2008. Yeah.
I'll tell you, I had a student come to me one time. Someone referred him to me, and he had a self-storage facility that he was about to lose back to the bank, and he was trying to figure out how to keep it. And it was in a very tertiary market. So my client asked me to see if I could help this guy out. And so I looked at it and I thought to myself, you know what? Okay, I know enough to be dangerous. I can understand that, the income, the expenses, but I don't understand mobile home, self-storage markets. That's the thing that I was lacking. So I went on LinkedIn and I did a search, and I found this lawyer in Little Rock, Arkansas. The guy owns 40,000 self-storage units. So I call him up and I say, hey, listen, I got this property. Would you like to take a look at it? Maybe you would like to buy it. And he goes, yeah, send it on over to me. And so about a week goes by, and I call the guy back, and he says, yeah, all right, well, let me tell you what's going on in this property. And he proceeds to tell. Now, I've only given him the rent roll and the trailing 12. He proceeds to tell me exactly everything that is going on in this property to a T, right down to the concessions offered, the occupancy issues. This guy nailed it. And so I said to him, I said, oh, so you're familiar with this property? You've seen this property before? He goes, oh, no, I've never seen this property before. I said, so how do you know all of that information? You're absolutely right. He goes, listen, when you've been doing this for as long as I've been doing it, you can look at the financials and know exactly what problems that owner is having. And I thought to myself, yeah, that's exactly true. I do the same thing with multifamily. I can look at the numbers and know exactly. And then we had a great conversation. He says, I said, how'd you get in this business? He goes, I represented self-storage owners and I saw them making all this money. I said, I want to do that too. So then he went out and started buying them, owns 40,000 now. And
Wow.
he told me about it's a formula. It's a numbers thing. Like it has to be within a certain geographical MSA that has X number of people, and there can't be more than X number of competitors in the area. And if we meet that criteria, we buy it. If it doesn't, we move on to the next one.
Right.
And it just was absolutely fascinating about self-storage. And I'm thinking that's the kind of guy that you would probably do business with in your fund.
Yeah, I'd love to know who it is.
Go on LinkedIn, and the he's a lawyer from Little Rock who's in self-storage, and he's solid, very solid guy.
Okay.
This was years ago, but definitely, yeah, write that guy's name down.
Okay,
Now,
great. I'll take a note of that. Thank you, Charles.
Sure, yeah, he was a good guy. That guy was smart. And okay, I got two more rabbit holes to go down to.
Okay.
I won't get through the second one, but I got to talk to you about this. You said that there were at least 7 reasons why multifamily, in your opinion, is overheated right now. Now, Paul, you and I are very conservative. We understand, that neither one of us is going to overpay for property. We're not looking to get rich quick in this business whatsoever. But I may be a little bit more bullish on this market, multifamily market, than you are. And I love, first off, I can tell you, I could have this conversation for hours. This part of the business I absolutely love. So why don't you try to throw in a couple of your reasons why multifamily is overheated, and let me see if I can volley them back over the net and see if we can have this figure out who's right, Paul Moore or Charles Dobbins when it comes
Okay. Fantastic. Well, I think that the 7 reasons off the top of my head. Now, first of all, I just want to be clear. I still believe everything I wrote in my book called The Perfect Investment. In fact, I'm actually publishing it through an official publisher this year. Morgan James Publishing is picking it up because it's still selling pretty well. And so I still believe everything in there, but I do believe that a lot of people have jumped into this. I guess they all read my book. And so I just think it's overheated. So number one, I believe that institutional investors are causing some problems for most of us. And here's why. They used to be, the REITs, the life insurance companies, the pension funds, they would be on the coasts, plus Chicago. They would be, in these San Francisco, LA, New York, Boston. But now they've moved into secondary and even tertiary cities. They're buying smaller assets. They're buying older assets. They're buying less stabilized assets. And they're buying in smaller geographic areas. You never would have expected a REIT in Lexington or Louisville, but now they're competing with us there. So that's number one.
Okay, stop right there.
Yes, sir.
I don't disagree with you. And here's how I'm seeing it happen. I just went to Marcus and Millichap's regional conference here in Boston, and they were talking about the fact that over the next 4 years or so, they're expecting Class A property. The new construction in the primary markets, the vacancy is going to go from like 1.5% to 5% because I think they are absolutely overbuilding the A-class properties. Mm-hmm. And at some point, you run out of A-class residents, and they don't have enough. Now, on the flip side, what was also talked about, and I'm actually, Paul, focusing now on building, but I'm looking at building workforce housing,
yes.
Which to the new developers and the new brokers, they call that C-class property. It's brand spanking new, so it's not. Yeah, but listen to this.
I can believe B.
I had the exact same reaction that you did. Like, wait a minute, that's not C-class. C-class is, chiller boiler systems, single pane windows, right. Flat roof, built in 1970. But in the new construction world, workforce housing is considered a C-class property. It's brand new, but it has no amenities. It's in a secondary or tertiary market, and that's what they consider to be a C-class property. So that, and according to Marcus and Millichap, over the next 5 years, the occupancy rate on those units is 98.5% or higher. And it's just unbelievable. So in that market, this is still a very strong buy. Hey, did you just lift your table?
I did, but I didn't want you to notice. I just noticed my head was like right near the top.
Hold on.
Well, look at you. Okay.
What are you shopping at Kia?
For our listeners, hey. Okay. Anyway, Charles, it's amazing. I'm actually going to Chicago in 6 days to meet with a lady named Nancy Kapp. And Nancy is K-A-P-P. She's actually building workforce housing in the, a multifamily in the fastest growing county in Oregon, which is, I think, where Bend, Oregon is. And she has the exact same argument. And we're actually very interested in investing with her because of what you just said. I completely agree.
Okay, so what I've done, and I'm right now in southern New Hampshire. Mm-hmm. I love New Hampshire. Tax-free New Hampshire, living, bordering Massachusetts. The town I'm in right now, I'm 3 miles from Massachusetts. I looked at all of the housing, the workforce housing that's already performing between Nashua all the way to the seacoast in New Hampshire, about 9 communities. And as I was doing the research, you just go on apartments.com, you type in these towns, and you'll see that every single apartment building has a waiting list to get in.
Wow. Yep.
Yeah.
Same with Nancy's deals. She said every deal that they've done, and they've had to have a lot of discipline to keep their rents down because they could go up with a waiting list of 50 people. But she said they don't do it.
I'm telling you right now, when we're offline, I want to get a contact information because the biggest issue, had a couple conversations with commercial brokers, and they're all telling you bad stuff. But the issue is the land. And
yes, that's right.
That's always, I'm sure that's going to continue to be the issue.
Right.
Where you go. So,
yep.
All right, Paul. So you did not win on point number one. Let's
Yeah.
give you option for point number two.
Okay, let's try number two.
Okay,
Second eye.
Hold on. Let's see if Ohio State can beat Boston College. Come on, go ahead, Paul.
Okay, so our second I is international investors. I have a friend named Ben in Shanghai. He's from Dallas, and he moved to Shanghai, and he actually said that the investors he works with, very big money people in Shanghai, said that they would literally buy commercial real estate in the U.S. at a 0 cap rate because they want to get the exchange rate. How do we compete with a 0 cap rate? How do we compete with people who can break even on their cash flow just to get into US dollars, where they claim they think they can make about 40% profit by keeping their money out of Chinese currency? That's the second group we got personally beat out by at least one Chinese investor who had that mindset.
Okay, let me tell you once again why I am right, and you're just going to follow along with me here. Is because I tell you, I was evaluating a client's deal in California, and in California, to get a 1.2 debt coverage ratio on the deal, they got to put 50% down.
Yeah, wow.
And you just think to yourself, well, you want to talk about an overheated market. That just doesn't make any sense whatsoever. But that's what they're doing. There's that foreign money that's coming in. Now, this ties back to what you were saying at the beginning about the institutional dollars going into the secondary and tertiary markets. They're being forced there by the foreign dollars.
Right.
So you're absolutely right. Okay, so that one you still haven't struck upon the one that I'm holding my hat on. But,
okay.
But
all right.
Once again, that's excellent point. This is
number three. Okay, so there's two I's and a one. And that one is 1031 investors. 1031 investors, we had a guy come to us recently and he said, look, I can either overpay like by, let's say 10% for the multifamily that my company's selling, or I can go pay, let's say 22% in capital gains, whatever the amount was, I don't remember. But he said, I'd much rather overpay for the apartments than pay capital gains tax. So I think that is a factor as well. What do you think?
Okay, it's so funny you say that, because this morning, one of my students lost out a deal that she'd been working on to a guy who had 1031 money, and he definitely paid more than the asking price for the exact same reason that you just gave. So, but let me talk about the flip side of that. The benefit to that is, as an investor looking for funds, you got to hang out on those 1031 sites to find those people, because those guys are looking for deals. And if you can bring them a deal, then you might be able to partner with them, because they've got the money. They've got to put it to use within a certain period of time, or they're going to lose it. Yeah. And they'll be willing to work with you on that. So yeah, that's a very good point. Very good point as to, okay, all right. So far it's a draw. Right now it's a draw.
Great. Okay, my next I is IRA money, and I concede in advance. This is a very minor one, but I think that there's more IRA, more self-directed solo 401k money than ever before. And for some reason, which I can't explain, Charles, it seems to me that people with IRA money are a little bit less careful in their investments, and they're willing to be a little looser and to say, well, it's only IRA money, I'll take a chance. And so I think they're overpaying a little bit. I don't think that's a huge point.
Yeah, I agree with you. And on both points, it's not a huge point, but it's probably true. I might be guilty of that myself. I just put some money in a friend's bank, and I don't need it for 10 years. Like, hey, let's see how I do. And so that, okay. So okay, that was the lowest common denominator.
Yeah, sure. Okay, the next one is the Nuru effect. And you say, what's a Nuru? Well, I think it's new gurus. These are people who weren't necessarily even investing in 2007 in real estate. And there's nothing wrong with that.
Or maybe they weren't even alive in 2007.
Or they were in junior high school.
Exactly.
But now they're gurus, and they're getting paid to train people to overpay. Is that impacting it, Charles?
I just found, folks, for those of you watching at home, I just made my new best friend. Paul Moore is my new best friend because he sees it the same way I do. Paul, you cannot believe how accurate that statement is. And let me give you some real life examples, okay?
Okay.
There is one guy out there, and I say, many people have listened to me and know I say this all the time. There is one guy out there that says that you can overpay for multifamily property because the price never goes down. And that's the guy that's only 10 years old, because I can show you some of my properties that never came back in value back in 2007. So don't tell me that the properties don't come back in value. I'm a living proof. And this guy's out there. And all it's going to take, Paul, is for the market to turn and one investor not to get the money they thought they were going to get, and they go run into the SEC, and this guy goes down the toilet because the SEC would love to get this guy's pelt on their wall. And so to hear that, and then I had I was at a mastermind group in Colorado, and I sat down with this guy, and he was a realtor from Charleston, South Carolina, and his family, he owns a big real estate agency. He's very, very successful, and he mentions the name of one of these Nurus, okay. Mm-hmm. And I said, oh yeah, I know him. Actually, he was on my podcast, and I've interviewed him, and he said, yeah, and you could tell that the guy from South Carolina and I were doing that little dance, where one of us wanted to say something, but didn't know where the other person was. It's like, you don't want to run out and tell people you're a huge Trump supporter, to find out that they're, with Planned Parenthood or something. You're kind of waiting for it. So ultimately, probably after another Manhattan, this guy comes along and says, I met with this guy, I had dinner with him, and I just he wanted me to invest with him. I looked at his what he does, and he's buying deals all the time. Yeah. And the deals, nobody's finding these deals. These numbers don't make any sense, but it doesn't matter. And here, my wife said it best. The guy is a transactional investor. Right. And that means that all he's after is the acquisition fee. Yeah. You know what I'm talking about.
Charles, I was at a conference in Miami in December of 2018, and I was really enjoying the conference, and all of a sudden some guy came on stage, and I thought, I recognize that guy. He wasn't on the agenda, and it was a very, very famous multifamily syndicator, and I was delighted. Well, he said, you know what, folks? He said, it's okay to overpay for multifamily. Just get in the game and get involved. You'll never regret it. And I literally, Charles, thought there was going to be a punchline, like he was kidding, but he wasn't kidding. And actually that quote went all over the internet after that. And you know what? I've been reading Warren Buffett. I've been reading, a lot of these guys who are, Howard Marks, Ray Dalio, they completely and absolutely disagree with that attitude. Absolutely. And my money's with them.
Yeah, my money's I got Ray Dalio. Like my 401k investments are all based on Ray Dalio's.
There you go.
And same with the guy from Vanguard, his numbers.
Yeah.
Let me tell you, are we talking about the same guy?
Probably.
Yeah, I think we are. And, this guy was, like you started off this conversation, this point, this guy was not in the market back in 2007, 2008.
Yeah. I don't actually know that fact either way.
I don't either.
I think you're right.
I suspect I'm right too. Wow, Moore.
Yeah.
Wow.
Yeah.
Wow. Hey, wait a minute. I just, you're not in relation to a guy named Kelly Moore, are you?
No, not at all.
All right, because he's a buddy of mine out here, and he went to Ohio State, and he's a huge Ohio State fan.
Oh, okay.
It's disgusting.
Tell him I said hi.
Okay, I will. I will. Okay, what's the next one after Nuru? What's after Nuru? Because we're banging through this, and I'm not in disagreement with you.
Yeah, I think the next one, Charles, is just the simple fact that the Jobs Act of 2012 combined with the world is flat idea of, brought on by the internet, allows way, way more people access to invest. And so now we've got investors investing as little as $5 or $10 or $20,000. We've got all kinds of accredited investors. The wealth levels are record levels, and millions of people who couldn't or didn't know about investing in commercial real estate are now able to invest. And I think just that supply and demand of money is the next sixth of the seven reasons I think we're at where we're at. That's what I think.
Yeah, I'm not so sure if that is as strong. I know why it's number 6 out of your 7. But I don't know. I mean, the people that you deal with are all accredited. They're all, making good money. But the issue that you're talking about there is secondary to the fact that there's so many of these investments that are just overpriced, and because I always tell people you can fix anything on a multifamily property. You can fix the roof, you can fix the foundation, you can fix anything. You just cannot fix overpaying for the property.
Right.
And that's it. So,
right.
All right, number 7, and I'm going to give you the one thing that you have not raised yet that I'm going to hang my hat on.
Okay, great. I just think it's the simple fact that cap rates often trail, or I should say that are a little, maybe 2 or 2.5 points higher than interest rates. And interest rates are hanging around this, more or less all-time low. So it makes sense that people would, not invest in T-bills, the risk-free amount, in the 1% range. Right. They might be willing to pay, let's say, 4.5% for a cap rate, when they before would have rather had a 4% T-bill than a 6% cap rate, if that made any sense. Anyway, you get the point. It's low interest rates.
It's that spread between the cap rate and the yield. Right. Okay. But that's pretty much the same as everything you said before about looking for investment dollars. Investment dollars chasing after some type of yield. Yeah. So, all right. So let me tell you how I look at it. And the thing, first off, this is not 2007's economy. This is a much different economy. I talk to people about my most favorite movie, The Big Short, and my most favorite scene in that movie is the stripper scene, where the stripper owns 5 homes. Well, today, a stripper is not going to own 5 homes. The financial underwriting for the mortgage industry has gotten so much tighter. It's not like it used to be. So we don't have, we were going along, even when the market crashed, Paul, I never missed a mortgage payment. Everything was going fine. It was just the cap rates, the value of my properties. When the notes came due, I couldn't make up the difference because of the loss in value.
Right.
We are not at that stage. The stock market is doing great, and the stock market could go through a correction, but I honestly think the stock market going through a correction is entirely different than the commercial real estate market, the multifamily market, because it would not go through the same similar type of correction like it did back during the Fannie and Freddie period. And the reason is, Paul, is we are having more and more demand for our product. And our product, our apartment units, the demand for our product continues to rise like it never has before. And as a result, we don't have enough stock. We don't have enough supply to fit that. And so therefore, that's why the market's holding on to is that we can keep driving that interest, the rents higher, which is forcing the NOI. When you add in here the things like student loan debt. My kids are in their mid to late 20s, and they have no desire to own homes. It's just not. If anything, they will buy a vacation home somewhere before they buy a someplace to live, because their lifestyle is such that they just move around. They don't want to be tied to it. And I really think it's a different mindset, different demographic than it was years ago. So it's fascinating.
The core of my book is 5 reasons. The core central theme of my book is 5 reasons that you're right. So I could go through that real quick if we had time, but I think we're almost out of time.
Oh, no, Paul. Well, first off, let me just, let's definitely do it. Let's talk about this. This is great stuff.
Okay, so in 1995, the federal government decided that anybody who could fog a mirror should own a home. And so they greatly relaxed the regulations, as we all know, but they didn't just relax the regulations, they mandated that banks and mortgage companies give loans to all kinds of people.
Yeah.
Now, the
It
homeownership
was the
rate,
Community Reinvestment Act.
right,
Like I did
the
my
homeownership,
thesis on it.
oh, did you really? Where?
Yeah, back in college from economics. Yeah.
Oh, that's awesome.
Yeah.
So I didn't really know much about that back then. Of course, I wasn't in real estate in 95, but the home ownership rate, which had been hovering between 63 and 64% for decades, shot up to 69.2% by 2005. Well, I had a friend who actually bought a $600,000 McMansion at he had a $40,000 income. He bought a $600,000 McMansion as his second home back in his hometown to impress his friends and family. He didn't even make more than a few mortgage payments on that before he lost it. But there was a lot of people who lost their homes. And of course, what happened from 2005 to 15 in the second decade of this saga is that home ownership rates fell from 69.2 back to 63%. Every 1% drop is a million new renters in the renter pool. But from the 2007 to 2012 range, there were virtually no apartments being built. So there was a 7-to-1 in equity in demand versus supply. Now, what's driving this? That's the first reason of my 5, if you will. Second reason is baby boomers, smallest rental group in the US, actually the fastest growing rental group, and statistics say when they rent, they'll never go back to buying again. Now, one of the reasons they want to rent is they realized in the last recession, their home wasn't their greatest investment after all.
Yes.
Their parents and their grandparents had lied to them. So they found out that, renting was an okay alternative. And a lot of people your and my age began to rent. Another reason is millennials, and you already said it. They don't feel like it makes sense to be tied down to a 30-year contract on a seemingly overpriced home when they might have new opportunities, new friends, new jobs across the city or across the country next year. The next group is immigrants. Immigrants rent more and for longer than people born in the US. And then the last group is Gen Z. Now, we don't know exactly how Gen Z will pan out, but at this time, with record student debt and credit card debt and low desire to own a home, it seems like their 95% rental rate will continue for years to come. So that's the 5 reasons.
Okay, have you read, and I don't think you have, because you were using some terminology in there, have you read the book Big Shifts Ahead?
I know about it. I have a friend who's dying to get me to read that, but I haven't read it yet.
Paul, you gotta read it. It's by John Burns and Chris Porter. Let me tell you something. I'm going through it right now, and it is mind-blowing. And one thing that you're going to do after you read that book is you're not going to use the terminology that people use regarding generations, like the baby boomers and Gen X and Gen Y.
Really? Why?
Okay, listen to this. I'm a baby boomer. I was born in 1964. The first baby boomer was born in 1946. I have nothing in common with somebody in the same generation class.
Yeah, so good point.
These guys did in Big Shifts Ahead is they put it into decades, 60s, 70s, and they named each decade based upon what the social change that occurred for those people in the decade. But here's part of the problem, because even people born in a decade still have very differing demographics. For instance, the people born in the 70s, let me see if I get this right. It was people born in the 70s. No, maybe it was the 80s. I can't remember. But the people born in the beginning of the decade, when they purchased homes, they worked, they built up equity. And then the people at the end of the decade, when they purchased homes, just like people 7, 8 years older than they were, when the market crashed in 2008, the people that were born in the beginning of the decade still were safe. They still have a lot of equity built up in their house. Whereas the people born in the end of the decade are broke. They have no equity in the home. They had to give it back. They moved back home with their parents. All that type of stuff happened. And I'm halfway through the book, but Big Shifts Ahead is fascinating. It's all really boils back down to real estate. These guys are real estate analysts. And so they're really taking,
No, I didn't know that.
yeah. And so they really take the demographics of what's going on and what's about to happen, and they tie it all together. And as to what's going on with real estate. And it's fascinating.
Wow.
Absolutely
Okay.
fascinating.
So one of
Yeah.
my real estate investing friends and a guy you would love to have on your show, Chad Corbett, he was really, really telling me how great a book that was. And he said there's another book that's very similar to that he likes just as much, but I honestly can't remember the name of
Oh,
it.
you got to get me, because I devour these books. I love
Okay.
them. They're fascinating to me. I
Yeah.
love multifamily economics. I love real estate economics. It's just so
I'll see if
cool.
I can find out before this show's over, but let's roll. Yeah, this
Okay.
is great.
All right. So listen, we're going long. I think my next call has already come and gone, but that's totally fine because I'm loving this. But I got to wrap it up by asking you something that everybody wants to know, Paul. Talk to me about how to create a fund. How did you do it? What was this your first foray into syndication? Did you do a one-off at any other time? Did you have trouble convincing people to invest with you in your first fund? How did it go for you?
I had a business partner from a Harvard University guy, Wade Myers.
Is this because he couldn't get into Boston College?
Yeah, that's exactly why, I'm sure, or Ohio State. And
Exactly.
anyway.
And you can use that joke whenever you want, Paul.
Okay, great. Thanks. I'll remember that. He was trying to get me to do a fund for years, and I couldn't get my brain around it. And I actually thought, oh, it sounds like a blind fund. It sounds like people won't trust me. But, I came to realize that the people I wanted to invest with were people I deeply trusted. And if I couldn't trust them, I wouldn't invest anyway. And so we decided to pull together, after doing quite a few one-off syndications, we decided to do a fund, and we call it semi-blind. As an attorney, you may call it blind, but we basically said, here are the criteria. Here's exactly what we'll be investing in. Here's what we won't invest in. And so you can know in advance, and we'll even tell you, here's a few operators we're probably likely going to invest with. And so that's the type of thing we set up. And again, our goal is to build trust with people. We put out good content to get to know them. We have conversations. We try to meet them in person when we can. And by building that trust, we're in a position to where when we roll a fund out and we put 44 or so assets in it, like we did in 2019, those people are with us and they trust us. So yeah, it was the best investing experience of my life so far.
Wow. Okay. Now, what's your minimum? What would it take for somebody to get into your fund?
Yeah, so it's for accredited investors, and we have a $50,000 minimum.
Okay. Now, let me ask you this, and this is one of the mechanics of running a fund that's always kind of perplexed me. Sitting on the money.
Yeah.
You collect all the dough, you've got it in there, but you haven't put it to work yet. How do you solve that problem? Or do you get a commitment from someone and maybe 10% of their commitment, and then you wait until you have a fund or an investment to invest in, and then you go collect their money? I mean, my biggest concern is the velocity of cash.
Yeah.
And so how do you solve that?
Yeah, it's closer to the second. We actually don't take any cash until we're ready to invest it. So for example, we might announce, this is just an example, we might announce we're doing a raise for the fund on March 5th, do a webinar on March 8th, start collecting money March 9th, get it all rounded up by March 29th, and then invest on March 31st. So like a 3-week period.
Wow. How big are the funds?
The total fund, yeah, the new fund we're doing this year is a $30 million fund. And so last year we exceeded our goal of 10 million by 30%. We raised over 13 million last year, so we're going for 30 this year.
Okay. Paul, we're coming to the end. This is where you give your commercial. How can people find out about your fund, about investing with your fund? Give us your information.
They can reach out to me at my company website, which is wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
Awesome. Paul, I can't wait to bump into you at at one of these events. And boy, we're going to have some talking to do.
That'll be great.
Offline. Yeah. So you owe me some stuff, like even Chad Corbett's contact information.
Okay.
But then I also am going to probably ask you offline if if we're talking about the same guy.
Yeah. And I think we are. I wanted to also mention that we have a 5-part e-course. A lot of people don't know how to get involved in commercial real estate investing. And if they want to get a copy of our course, it's free. They can just go to wellingscapital.com/resources. And I should have mentioned that earlier.
No, absolutely. Get it in here now. That's great. Hey, Paul, I've thoroughly enjoyed our time together.
Me
This
too.
has been a blast, and I will look forward to meeting you face to face.
Absolutely. I look forward to it as well. Thanks, Charles.
Thanks, Paul. Talk to you soon.
All right. Take care.